it's been an interesting week, and we got some data that came out throughout the week. And before we jump into the Jackson Hole meeting, just quickly want to go through some of the data that came out this week. And before I jump into the EU CPI, I just quickly wanted to check the US CPI, right? As you all know, Federal Reserve keeps saying that 2% is a magical number that they're targeting as one of their mandates. But the last time it was below 2%, it was in February of 2021 when it was actually 1.7%. And as you see in the last 3 months, the inflation has been going higher and higher, right? So it's not actually going down, but the markets are actually, well, at least from my perspective, it looks like the markets are pricing in already another rate cut. But why cut the rates? If you see the, inflation's going higher. And so I will jump into that a little bit later when we discuss Jackson Hole symposium, but that's just something I quickly want to address before we move on. And so in EU, the CPI came out again 2%, right, in the month of July. And I mean, year over year, that days from the last year's July, right? And so, they have met the target, well, quote unquote, and they're cutting the rates. And the thing is, what's really magical about this number, if you realistically think about it, you go to the store and you wouldn't buy apples because, let's say, the price hasn't increased enough for your, whatever your goal is, right? So to speak, So if let's say nobody goes to the store to just say, oh, do you know what? I'm not going to buy these apples because they haven't increased in price, since last time I came here or whatever. Obviously you just, an average Joe and Jane, average everyday people would go to the store, they would try to spend, less for the same quality, that would be ideal. That means your standard of living is actually going higher, right? Because, for the same money that, let's say, you earn, in a case, let's say you haven't got a salary increase this year or whatever, you would say, oh, this price has been going down, so that means I can save some money, instead of spending more money, and that means I can buy something more, something else, that means I have some change left over, and those 2%, 5%, whatever, 1.4% for that sake, really adds actually up. And so the 2% number is just a magical BS nonsense number, they came up with, it was actually New Zealand, if I remember correctly. And so what I think is, realistically, is that government officials don't want the inflation to be in the real economy, like goods and services or whatever. What they want 2% is realistically in the assets, right? Because if you think about it, that most of them are relatively wealthy, wealthier than average Joe and Jane, right? So they they have some assets, real estate, property, whatever, and so if the prices actually decrease from what they own or stagnate, well, what's good in that, right? Because they won't make any money on that. They obviously won't make money on that. And so I think that's where realistically it is that they actually want the asset inflation to be like 2% or whatever. But also it's impossible to micromanage such small increase, 0.1, 0.2, 0.3, even for that matter. If you think about it, before 2020, right, inflation was I don't know, below 2%, right, on average. But then and so they were like, oh, you know what, we're just gonna print out a little bit of money, we're gonna expand the credit as well, and so we're gonna make up for those years. And what they did, the official inflation, spiked up at 9.1% in June 2022, right? And so you can't realistically, manage that. And also the methodology they actually use, right? I don't know realistically about EU, UK, or Canada in that matter, but I'm pretty sure it's actually the same, or somewhat similar. But realistically, the methodology they've been using since 1984, I believe, is actually underestimating the real inflation. And if you go to shadowstats.com, if my memory serves correctly, John Williams, right? He uses old methodologies, instead of substituting for some goods in the basket, because the whole point is not to change the goods every year, just because they look bad. You always use the same thing over and over. And so what they did, they actually changed the methodology of how they account for the inflation, how they combine the statistics. And what they did, for example, is that they substituted, let's say if the beef prices have been going up a lot, they said, okay, so we know that people probably going to switch to chicken, or some other meat. There's a cheaper version of the beef or whatever, and we're going to start counting in the chicken prices, right, instead of the beef price. But what's good in that? You substitute the thing, and that's how you underestimate the inflation. The same thing accounts for the real estate as well, what they change, because now they do like surveys rather than the actual prices and stuff. And so it's all BS and nonsense number that they come up with, 2% here, 2% there. The real inflation is probably double of that. It's probably like 4 or 6 or 8%, realistically. And same in UK, right? I can't remember, but I'm pretty sure they were talking about rate cuts as well. But what's good in that? The inflation have been going up since, September of the last year. And then, look at that, it's 3.8, the official number. The real number is probably twice as high as this, if not even more. So you gotta have some positive real interest, to subdue the inflation rather than just cut the interest rate to get the number down, because also the neutral rate that they're, sort of talking about, nobody can know that, right? So it's all BS and nonsense. They just inflate the assets, they depreciate your currency, right? So essentially year over year, if we think 3.8% is the real number, which is obviously not, your currency, your purchasing power has been declined by 3.8%. It's like indirect tax, So, for wealthy people, it's probably really good because their assets are appreciating. So those 3.8%, in the grocery store or somewhere else, it doesn't really matter as much as it matters for average, Joe and Jane or whatever. Same with Canada, this 1.7%, nothing good about it because you still lose 1.7, you have lost already 1.7% if you assume these are the real numbers, because they're official, they're supposed to be real, but, realistically, I don't think they use a good methodology there as well, but I actually don't know. I need to check into that at some point. Moving on to the manufacturing PMI in USA, it's been declining for the last 7 months. Yeah, 7 months. The reading above 50 indicates the manufacturing is in a good state. It's growing. It's the business going forward. Anything at 50 or around 50, let's say, is just stagnation of that. Nothing really has changed. On the good side or the bad side either. But below 50 means that something's going wrong, right? So there's less business going on, and what it tells me is that obviously before I say something about it, it's just you need to understand that these data takes actually time, and they also do surveys that on how they in order to get their statistics done. And Trump actually had to take over the Biden's economy, right? So you can't really blame all of it on Trump, but however, as you remember, he's been talking about business moving back to America and stuff. It doesn't look like it's moving back. These are some bad numbers. That means the economy is actually decreasing, numbers wise, I guess. Maybe and also in the real economy, because this is just a reflection of that. How accurate statistics they've done, I don't actually know, but assuming that the numbers are actually are somewhat precise, that it's saying good, is at some point if these numbers actually keep coming down, we'll see higher unemployment claims, because if business not doing great and suddenly you have over capacity of employees, and you're gonna start getting rid of them, because obviously, as for most of the businesses, labor is the highest cost of the business, rather than the actual manufacturing or production or distribution, whatever you do. Most of the businesses, spend most of the money, on labor, on wages, salary, taxes. They need to pay, health insurance and all sorts of things. So, we'll see how it actually plays out. In the EU, however, it's been pretty bad, but as we see, the numbers are going up, so that's not too bad, at least it's increasing. Again, I don't know the methodology they actually use well enough to comment on that, but at least it's going higher, assuming these numbers are somewhat, accurate or something. Can't say the same thing about UK, still below 50. In fact, it's been below 50 since September of last year. Again, not very great for the economy. Philly Fed manufacturing is just the pretty much the same thing. And if we look at this, what the companies or the managers said in the survey was that both price indexes remained elevated. The price paid index increased 8 points to 66.8, its highest reading since May 2022. The current price received index ticked 1 point to 36.1. Most firms, 64%, reported no change in price received. 36% of the firms reported increase and none reported decrease. Now, what that tells you is that somewhere down the line, price of the goods will be higher, because as you know, before the final goods come to the store or online store or whatever, they need to be made, right? So manufactured or produced or whatever, assembled, distributed. And so if one party somewhere down the line increase their price because their cost of production has gone up, or the commodities, like let's say copper, or let's say some sort of metal, or whatever commodity has gone up in price, right? So that they're not gonna absorb the actual price increase, right? They're not gonna take it out from their profit margin, right? So what they're gonna do, they're just gonna pass it along, right? So the next entity that is gonna receive the good, and until the end, once the final product has reached the store, exchanged all of those hands to actually make or produce or whatever, the price is gonna be increased no matter what, because no business, right? Realistically, nobody wants to absorb those prices, as at least to the most of the part, at least as far as I know from studies done on tariff increase. Let's say, at some point, about 75 to 90 with the change percent, if my memory serves correctly, is gonna be passed on to the consumer, meaning that only a small percentage of the actual price increase, from the tariffs is only gonna be absorbed somewhere down, the production line or distribution or whatever. So, and it's the same thing applies when you produce stuff. If the price of producing actually has gone up, well, the company or whatever is going to pass it down the line, down the chain. So once the final goods reach the store, that they're essentially going to be in a higher price. And so we will probably have to see next month's CPI reading and see if the actual price of, let's say, somewhere in one of the sectors actually have been increased. And I specifically wanted to talk about US U6 number rather than U3, because in U3 number, again, they use a methodology that underestimates the real number. If you take U6 number, which is more realistic number, 7.9%, right, it's probably more realistic. And as you see, since May of 2023, it has been increasing. And the difference in U6 number is that they actually account for all the discouraged labor participants, the people that basically have been discouraged or couldn't find a job after whatever the weeks, I think it was like 7 or 8 weeks, they actually discounted from U3 numbers. So that's why you can't see those numbers increased as well, as much as U6 number, because in U6 number, they actually, they account for that. And so this is a more realistic number, which is still climbing up, as we see from 2023. And if we historically look, then normally what happens is the employment rises slowly, and then suddenly, it just skyrockets, right? So that's another thing just keep in mind that is going on, and it's not very great for US economy, because obviously the less people, work, the less productive we are, so it's not a good thing at the end of the day. And I want to talk about Jackson Hole Symposium, right? Specifically about Jerome Powell speaking on Friday. Now, as you know, Fed's dual mandate is maximum employment and also inflation goals, right? Steady prices, well, as was back in the day at least. And what Powell said actually, to me, seems like they're abolishing, well, not officially, but currently they're abolishing the inflation target, right? Because unemployment has been slowly but still going up, even on the U3 number, as we saw. The unemployment is now at 4.2%. That to me seems like, I think in September in September, they're probably gonna do a rate cut. And so inflation from there on is just gonna go higher. And it's just, because if you think about it, the money is gonna be cheaper to acquire, right? And it's just a matter of time. They will also start the QE, quantitative easing, basically expanding money and credit, right, in the economy. And so that is always a bad thing. Not that it really works, we can maybe go through that in another video. But what that means is that we're basically going into the stagflation, because if you think about, unemployment going higher, and now the inflation is going to go higher as well, not that it has been going, it obviously has, as we saw, but if both of them actually are going higher, that's just a perfect combination for stagflation. And also he mentioned that GDP growth has obviously slowed down 1.2%, right? But it's also a dodgy way of they actually do the calculation of GDP, because they have something called consumer spending. But what does spending have to do with production? Well, really nothing, because everybody can consume. There's nothing really special about it. So realistically, if we think about GDP, just side note, it's just an inaccurate number in the first place. So it's probably even lower, because consumer spending actually in that methodology actually is a big part of the whole number. So that's that. And overall situation, I think, is just going to be really good for the markets, at least maybe for a few weeks, unless there's going to be some profit taking. But it also comes really with an interesting timing. If we assume that Federal Reserve is going to ditch the mandate, which I think they definitely will, because from what he says, basically, we don't care about inflation, we care about unemployment more than inflation, meaning that you're going to keep losing purchasing power, just so that whatever that they're trying to achieve. But overall, that's just going to add fuel to the fire and probably increase the actual unemployment, because if you think about it, the prices are going to be higher now, right? So people may look for another job again, because let's say their current job doesn't pay as much that they need to survive or whatever, but they're going to have to downgrade their standard of living. So it's overall, it's just a perfect combination just for the stagflation. I think we are already in one. Maybe not as bad as in 1929 or something, but we're definitely somewhere down in that line. But the timing that I wanted to say is about reverse repo operations. The facility is currently at 36.27 billion, which basically says that the excess liquidity that there is in the collateral market, is basically closing to be, not abandoned anymore, right? So we'll see what's going to happen, in the collateral markets, what's going to happen with the swap spreads and stuff like that, because that is an interesting timing, if we think about interest rate cuts and, easing the policy, currently we have quantitative tightening QT, which is basically 5 billion, I think it was, if my memory serves correct. But realistically, 5 billion, right, on 37 trillion debt, it's a spit in the sea. It's literally just a rounding error at the end of the day. So I think if I'm actually not mistaken, they're not actually paying it off. They're just rolling over for the new interest. So we'll see how it plays actually out. It is pretty interesting. And the last thing I really wanted to talk about just quickly is the United States owning 10% of Intel, right? And in Constitution, the export tax is actually unconstitutional. And here I have put a quote from the actual clause that says, "No tax or duty shall be laid on articles exported from any state," meaning that you can't put any export tariff. So what they essentially do, right? So in case of Nvidia and AMD and now Intel, right, they're putting those companies in advantage. Yes, it's maybe Nvidia and AMD is gonna essentially have to pay like 15% on their revenue from China, whatever they sell on China, but they still unconstitutional, right? Because they're still gonna take your money, and same probably for Intel. And the problem is that everybody else, the chip companies, whatever, they're gonna have to probably pay higher prices. And so basically those three companies, Intel, AMD, and Nvidia, if I'm not mistaken, those were three, all of them are actually in advantage, right? Meanwhile, everybody else is just in a disadvantage by that, because essentially they're gonna have to pay more, tax on their revenues, And also what it does by owning 10% of Intel, as a government, I'm not even sure if that's even constitutional in the first place, but maybe in countries, maybe it is. Although, if you think about it, what kind of free market capitalism does the United States actually have? There is socialism. There's nothing free or capitalism, about this. Usually you're gonna see something like this in a communistic country or a Marxist country or a socialist country, where the state of the country actually, basically the government owns the local businesses, where they have some sort of saying, that only that kind of thing you're gonna see in socialism, not in free market capitalism that essentially we're supposed to be, And so what it does, right? So it could mean that potentially they will actually do some sort of policies where it actually comes good for Intel, because might as well, if they own the company, they might as well just, do some sort of policies that are good for that, squeeze the juice out, as much as you can. Whether that is going to be the case, I don't know, but that's just, my sort of speculation that could actually be the case, Right, so that's pretty much it what I wanted to discuss this week. If you find this helpful, like and subscribe, share it to the people that you think, could learn something about this, that's the whole purpose what I, started making these videos, is that people actually can learn, just trying to put everything in a very simple, simple words that everybody can understand, and maybe we can just dive deeper with time in some of the stuff if you let me know what it is. Right, so thank you very much, and I'll see you next week. Peace.